All right, Yield Nerds, episode 130. We've come a long way. I started with trying to understand fixed income, what bonds are, what preferred stocks are, what convertible preferred stocks are, and then went into value investing. And as I search for yield, I am now understanding commodities. Welcome to this episode, and we now have 359 subscribers. Thank you for your support. If you're new to this show, please consider using the playlist to pick the earlier episodes which are at a more basic level. And please remember, I have no magical powers. You need to do your own homework. Most importantly, if you do not agree with the statement, I love learning, please send me a note, yieldnerd@gmail.com. All right, this agenda has four parts. As usual, we'll start at the market temperature. We have 110 days to go to the election, which I kind of see as a marker for a lot of volatility for equities, so I'm preparing for that. And I have a thesis, which is that the dollar is going to be cheaper in the interim. And by that, I mean in the next 6 to 9 months. However, it is going to lead to greater inflation down the road. So I will explain how I'm trading based on that. And so my portfolio is the blue line here, and the brown is the benchmark of a conservative short-term portfolio. And as you can see, I sleep very well at night. My expenses are paid, and I bank about 3% after sales tax for the first 6 months. So I'm good. And this is the stability I look for. Now, you may be the more aggressive trader, in which case you probably have a different channel that you want to go buy all these growth stocks and enjoy participating in the wild rides. That is not me. Having said that, I am expanding my equity portfolio. I went from a meager 0.5% on May 1st to 1.13%. And so I add equities, but I have my own thesis, and that is what I'm going to share with you. And you may remember as well that my time to maturity is extremely low. I have a huge portfolio of T-bills, and as they mature, I invest a small fraction of them on equities, and the rest are on longer term fixed income. I do have some corporate bonds that I'm trying to get rid of or let them mature. Well, what do I believe, the economy is going to face between now and the election, and how am I preparing for it? Before I dive any deeper, I want to make sure you do not mistake anything I say for product pitches, politics, investment advice, or tax advice. I am not a wealth management advisor. Well, when there is volatility, my natural instinct is to not chase the rumor, so to speak, but to stick to fundamentals. And sometimes it leads to missing out on these wild rides, and other times it leads to a lot of peace of mind. And the peace of mind portion is more important to me, and that is why I do that. I buy things that I can certainly need, whether or not the economy is roaring. One thing that we all need is cash, and so I have a substantial portion in T-bills. The second thing is food. And as you may know, I harp on eggs a lot, and that's a great commodity product. It's not traded on the commodity exchange, but it is a great commodity product, and I like that. And energy is another one where we're all going to use it, whether or not there is a good economy, bad economy. In today's world, there is a lot of military conflict. And if there is a precipitous drop in a stock that still meets the value investment criteria, I do run my usual filters. And if a new one pops up, I take a closer look. I do not believe in miracles. I certainly don't think there is a truckload of money showing up on Wall Street, which unfortunately means the country is going to need a lot of debt. And debt is fancy for treasuries, and there will still be a lot of treasuries coming out. And as there is a lot of talk about lower interest rates, what that usually means is higher commodity prices. And why is that an inverse correlation? Because the United States exports many crops in US dollar. And so if somebody is buying a bushel of soy or a bushel of wheat or a bushel of corn, they pay in US dollars. When interest rates are high, the US dollar strengthens. And so the nation that buys the grain from the US has to pay more in their own currency for one bushel of that grain. When interest rates decrease and the US dollar drops, then the importing country has to pay less in their own currency. And so that is why commodity prices shoot up to balance that. And unfortunately, when that happens over a period of time, inflation shows up. And so my strategy in the next 12 months remains the same. I am going to be substantially in fixed income, but I am going to look for equities that match the criteria we talked about. And therefore, what would I do if I anticipated a cheaper dollar with the drop in interest rates and higher inflation later? And that's what I'm going to discuss with you in detail. Remember to make your own decisions. Remember, there are two divergent paths that are being proposed. One has tax cuts, which will decrease revenue. If revenue decreases, then you have to raise more money through treasuries, which means interest rates won't go down as much as you think they will. The second is infrastructure spending. And if you spend on infrastructure, that is going to increase borrowing, whichever path we take. Once you introduce the notion of interest cuts and you add one of these two paths, you are going to devalue the dollar. For the same reason we said earlier, if the US doesn't pay 5.25%, if the US only pays 3%, all of a sudden money will go to a different country that is reasonably stable. We don't have a good substitute today. You can argue the euro and the UK and Singapore and Switzerland, but they just don't have the kind of T-bill volume that we have. And so some amount of money will be directed internationally, some amount of money will chase foreign stocks, and all of that will lead to a cheaper dollar. And when the cheaper dollar is the reality, then you want to look at things that are made in the US and used in the US. So the foreign exchange rate of the dollar does not affect it. The second thing that will also benefit is US companies with foreign revenue. Again, if the US dollar is cheaper, then you would expect the foreign countries to buy more of that product, which may or may not happen sometimes, but you would expect that the dollar weakens, that the US companies with foreign revenue will benefit. What you don't want are companies that buy raw materials from foreign countries and sell into the US. This is the opposite of what you want. So what does that mean? And I put a bunch of stars and I'm going to start trying to match them. The first is, in my opinion, when you expect a weaker US dollar and higher inflation in the next 12 months, you want to go for defensive stocks, value stocks, not consumer discretionary, not the vacation stocks and things like that. That's just me, you do you. I still wouldn't jump on growth stocks outside of very small exceptions. I still would focus on low debt, even though interest rates may decrease. That doesn't mean a debt-ridden company is suddenly going to make profit. All that it means is they're going to survive longer. You need high cash flow and high profit. You want things made and used in the country whose currency may face some devaluation. And you also want companies that are based in that country with foreign revenue for reasons we discussed. And you do not want companies that sail against that tide, meaning they buy paying US dollar, and when the dollar depreciates, they have to spend more to buy their raw materials, and they sell into the US, which means it'll create inflation. So be careful about that profile. At least I'm going to be careful. And there is something that so far has taken an absolute beating. 27% over the last 3 years, and the number would be even worse if you looked at the last couple of years. And I'm going to tell you what that is. And I've been doing research on it, and the answer for that is wheat. Let me explain more. So if you look at all the commodities that are traded in the markets, and this goes from gold, silver, copper, and so on to corn, wheat, cotton, cocoa, if you looked at the last 3 years, you can see that far and away, cocoa has a crazy amount of increase in commodity prices. That's because supplies were affected. There was a lot of trading wars going on. The farmers didn't make the money, the trading companies made the money. But cocoa had a huge appreciation. Simultaneously, wheat had one of the worst depreciations. And natural gas 3 years ago with the war had a very high elevated increase in prices. However, you're going to see something interesting happen as we come towards today. When you start rewinding, you can see that for this year alone, cocoa still had a very high increase in prices, but not as high as the previous 2 years. And wheat again had a drop in prices, but not as high. So in other words, things are starting to come towards normal in both terms. One of them is coming up in terms of, rate of decrease, and the other is coming down in terms of rate of increase. And gold as well seems to have the same pattern. And as you start going farther and farther in, if you look at natural gas, for example, the rate of decrease of prices is slowly decreasing. The rate of decrease of prices is again doing the same thing for wheat. And by now, cocoa in the last month has actually dropped in price. Wheat is still decreasing, but not by much. And you start looking at the last week, and you start looking at yesterday, and you come to today, wheat has just broken into positive territory. In the meanwhile, cocoa is slipping more and more. Here is what I take from it, and you can look at natural gas. It's also trying to establish a bottom. I like to look at this and go, where do I want to be? And in my humble opinion, I don't want to be in gold. Gold has already started peaking and peaking and peaking. I don't want to be in cocoa. I am invested in copper, and copper, I have a small position in Southern Copper Company, which is a US-based copper mine. And you've heard from me before in terms of oil and transportation of oil. I have TK tankers. With natural gas, I have Quad Energy. And now I'm trying to look at wheat and see what can I buy that will hedge me towards a positive outcome. Let's understand wheat. The export of wheat. Russia is the largest exporter, but it has a bunch of trade curbs, as you know. The next is Australia, and third in line is the United States. Unfortunately, Ukraine's wheat exports have been affected terribly. So what does that do? I want to understand where US wheat goes to see whether that is a stable outcome or not. And before I even do that, here is an excellent paper. I've posted links to all of these in the episode. This tells you what is happening to wheat futures in an increasing interest rate environment. You can see that wheat prices continue to drop, and when the rates are kind of paused, wheat futures are flat. And the hope, based on previous information, is that when the dollar devalues, and that's the green line, when the dollar index starts devaluing, wheat futures should crisscross and go up. And that is what you would see. You can see in this green right here, as the dollar index goes up, the wheat index goes down. And so all indications are, and please do your own research, that when interest rate decreases show up, wheat prices should jump up. So who imports American wheat? These appear to be a whole bunch of reasonably friendly countries with good disposition towards the US, South Korea, Philippines, Mexico, and Japan. So I don't see them suddenly saying we don't want to buy American wheat. It's not, China is not on the list. China produces its own wheat. And other countries that aren't as friendly towards the US are also not importers of US wheat. So the odds of a lower US dollar increasing the purchase of wheat by some of these countries is actually higher, and I like that. So there are really two investment strategies if you believe in what I believe, which is that wheat prices are poised for an increase. One is to look at the commodity future itself, and the second is to look at companies that process wheat and also own wheat inventory. So let's look at the commodity futures. Please do your own research. There is an ETF called WEAT. That ETF is rated avoid by Market Edge, run away. And they own about 80% of their portfolio in wheat futures for December 2025, March 2025, and December 2024. All of them are after the election, and I kind of like that time frame in terms of commodity prices and inflation and things like that. They do own some amount of cash, but I would imagine they're going to keep buying more of these wheat futures as time goes on. And so that is one ETF if you want to participate in wheat futures. They do show you that this is the worst performing commodity. Even if you invested in a basket of all commodities, including gold and cocoa, you'd have done better. And so please be very mindful of what you're getting into. The second thing is to look at companies that process wheat. And the one I'll focus on is called Bunge. And Bunge is in the business of buying wheat, storing wheat. They also do corn and oils and things like that. and they are crashing and burning because of wheat prices and other commodity prices. Their sales dropped 29% because prices are down. And not only that, they also sell based on US dollar denominated loans. Imagine borrowing and you owe $100 a month every month and you're a foreign country, and the value of the dollar keeps going higher and higher and higher. You're not going to borrow from this particular person, you're going to go borrow from somebody else. And that's what I mean by, when the US dollar depreciates, you are going to see potentially, or I believe you're going to see that companies like Bunge will see a turnaround in their earnings. And Bunge has a couple of things going on. Their PE ratio is pretty low, 9, which is good. I mean, not for their industry, it's pretty consistent. Their price to sales ratio is a shocking 0.28, which means they have a lot of revenue at a low margin. And as you can see, their net margin is only 3%. But because it's a commodity-based company, when the commodity prices go up, their margins will go very, very high. They do have debt, which is higher than what I generally like, and everybody expects wheat prices to actually be lower, and I am sailing against the trend on this one. They pay a dividend, which is good. Not a wonderful dividend, but at least they can certainly afford their dividend. And so all things indicate here that if wheat prices do rebound, Bunge will be a very good company to look at. And so I've done my research. Let me explain my trades. I did put a few new ones in there. For the most part, these are all companies that are small businesses. Lights, LYTS, is another company that I did not have the time to discuss. They make light fixtures in the US and they sell to foreign countries. They do have one factory in Mexico, but most of their manufacturing is in the US. So I picked them for reasons that I discussed earlier. I did buy a bunch of Intel with all the commotion going on about semiconductors and Taiwan, stuff like that. Aside from that, the rest are all usual things that I already have, ORCAT, AMAT, and you can see I actually sold some treasuries in order to finance some of these. And I am continuing to build up on the preferred AMH, PRH. Please be careful, don't build up more than the daily volume or you'll have trouble selling. But that gives 6.8 something percent, and it's a stable company, so I liked that preferred stock. One of my new ones in the last week is Pulte. With interest rates decreasing, I expect Pulte to do very well. And so my holdings at this point here is Bunge. Yes, I did buy Bunge and LSI Industries, and they, there are some ups and downs, but I'm going to hold them firm. And aside from that, I do have Pulte. My luck is purely luck. It went up by 12% plus a couple of days after I bought it. And yes, I also did buy Teucrium Wheat ETF. I have a very small portion in it. If you know of another company that processes wheat and is a pure play, they don't do soybean oil and this and that and the other, and also wheat, please let me know. I would love to invest in them or at least do due diligence in them. Remember, even a broken clock is right twice a day. Do your own homework, and thank you for watching Yield Nerd.